Hi, and welcome to the chapter on financial statements. So some of you may be familiar with doing a budget. That's of all the financial statements that we're going to look at, that's probably the one that you're familiar with. For many financial plans, they might not go past just doing a budget. When we're doing comprehensive financial plans, it's going to include more than a budget and a lot of additional areas as well. When you're looking at doing something, for example, for retirement, it's going to include investments and tax planning, and we'll talk about estate planning, all the areas that are part of comprehensive financial planning. But in this chapter, we're focusing on financial statements and some financial ratios, and we're going to pull the information for those ratios from our statement. So let's begin.
So, last chapter we talked about goals, and we said financial plans always include goals, and those goals can be either short term, mid term, or long term. Our financial statements are going to help us achieve our goals. They're one of the tools we have in our bag to help us achieve our goals. For example, we'll be looking at a budget, and a budget looks at the future. And one of the things that the budget is going to include are, for example, our savings goals. And those savings goals, goal in themselves to save 20 bucks next week or to save $500 a month, whatever they are, those are specific goals themselves, but they also help us reach some other goal like saving for retirement. And so financial statements are going to help us achieve our goals. They're going to help us keep on track. They're going to let us know how we're doing. They're going to let us know where we are and what our strengths and weaknesses are. So, all right. Now, if you take a look at this, these are all things we're going to do as part of our financial plan. We're going to evaluate and plan major outlays. We're going to manage our credit. We're going to secure adequate insurance coverage. We're going to establish savings investment programs, manage employee benefits, reduce taxes, implement retirement program, minimize estate taxes. So those things, some of them are saving money, some of those things cost money, right? When we make changes to those are going to make changes to our financial statements. For example, they're going to affect our budget. If we increase our savings for retirement, we have to reflect that in our budget. Then if we go down one level, we're going to monitor and control income, living expenses, purchases, and savings on a monthly basis. If we make any changes to those, that's going to affect other parts of our plan. If we go a step down again, what are the results from what we've done? Where are we at in terms of our assets and liabilities? And a balance sheet will reflect that. What's our income and expense statement look like? And as we do those, then that may cause us to have changes that get reflected in our other financial statements, like our budget, and ultimately changes to our financial plan. We may decide at that point, hey, we need more insurance because we've done our balance sheet, for example, and we don't have enough liability coverage based on our net worth, something in that order. If that doesn't make any sense to you right now, that's fine. We're going to talk about all of those financial statements that we mentioned on this slide. We're going to talk about net worth if you're not familiar with that, and assets and liabilities as well. So let's move on. Financial statements help us gauge our financial health, monitor our progress and financial plans, and reach our goals. The three key financial statements we're going to look at are the balance sheet, the income statement, which is for us, it's going to double as a cash flow statement. And you might find some things either online or in the book that maybe they'll be labeled an income statement, maybe they'll be labeled as a cash flow statement. For us, for our purposes, they're essentially going to be the same thing, and we'll talk about why that is. If you're not familiar with these financial statements, that shouldn't be confusing to you. If you have done these financial statements and you've done an income sheet that looks different than cash flow for like a business, the reason is we record things differently for households, and it's just simpler the way we record them for households. So it might be a little bit different than you're used to if, for example, you've taken some accounting class. And then we're going to do a budget. So 3 financial statements you want to be familiar with: a balance sheet, an income statement, and a budget. And like I said, the income statement is serving also for us as a cash flow statement. Okay, so here we're looking at an example of a balance sheet for a family. And what is a balance sheet? Well, a balance sheet is a statement of your financial position at any given point in time. It's like a snapshot in time. It tells me it's good for that day when it's done, and it would have been slightly different the day before or the week before, and even more different a month before that, and the same thing for the time frame afterwards. If your balance sheet today will look different than your balance sheet a year from now. And that's because the value of things that you own can go up or down, and what you owe in terms of money can go up or down, and it can change day to day. These are recorded slightly different for households than they are for balance sheets, and we'll come back to that in just 1 second. And but let's take a look at the top of the balance sheet. It's got a label that says it's the balance sheet. It's got the name of the family. It's got the date it was made, so it's good for that date. I mean, it can still be useful for a significant time frame after that. It's just that it represents that date. That's all. So it's a snapshot in time. In this case, for this family, this is their balance sheet for December 31st, 2012. And that could even be useful today, years later, because one of the things they're going to want to know is, hey, has my wealth grown over this time period? What kind of assets have I accumulated? Have I accumulated assets that go up in value or assets that lose their value? There's all kinds of things the balance sheet can answer. So if you notice on the left-hand side, just under the name, it says assets, and it's on the left-hand side, and then it's got a dividing line down the middle. And then over on the right-hand side, it says liabilities and net worth. This is how balance sheets are traditionally made. You have assets on the left, liabilities and net worth on the right. Now, if you're doing this for a business, it might say owner's equity instead of net worth, but other than that, it's going to look very, very similar in how it's set up. And assets still mean the same thing, liabilities still mean the same thing, and even the term net worth and owner's equity is very similar. So what are assets? Assets are just things we own. So over on the left-hand side, we're just listing the things that this family owns. Think of the things that you own or your family owns, things like clothing and homes and furniture and cars, right? These are all the kinds of things we own. These are the things we're going to list, maybe in some investments. And so now you don't have to do this, but it can be useful, and it's useful in ratio analysis and just getting a better sense of the kinds of assets you own. It's a good idea to do subcategories for assets, and they did that on this balance sheet. So we have assets on the left-hand side, but we have it subcategorized by liquid assets, and then investments, and then real property, and then personal property. So what are liquid assets? We've already defined that. We said it was basically either cash, checking, savings accounts, money market accounts or money market mutual funds, and CDs, those things. And is that what they have listed here? Yes, it's those 5 things: cash, checking, savings, money market, and CDs. So the same things we mentioned last time in our lecture. So those are the liquid assets that they're going to record. And so you're just listing your assets. Now, one of the ways this differs from the balance sheet for a corporation is that families own different assets than corporations own. For example, a family does not own inventory, whereas a corporation might own inventory. And so a business will have, just different assets than a family will. So that's one of the ways it differs. Okay. The other way it differs is when we list things, like if you go down to real property, you see that primary residence and it says $185,000. Well, does that mean the price they paid for the home? Does that mean what it's worth now? What does it mean? Well, you list things on here for a family, you list them at fair market value. That means what they would sell for today. So it's what it's worth as of the date that they made this balance sheet. So in this case, that's what they're roughly what their home would sell for in December of 2012. And so that differs because for a company, we might list things at the purchase price. So at any rate, those are some of the differences between a corporate balance sheet and a household balance sheet. So we skipped a category. One of the categories was investments. And so if you're not familiar with these things, we have a whole chapter on investments we're going to go over. But they own some stocks, they own some bonds. So it has a category for CDs. So why are the CDs in 2 different areas? Why are they under assets and why are they under investments? If you remember from the last lecture, we said CDs less than a year we're going to consider liquid. CDs over a year we're going to consider not to be liquid assets, and so they'll be considered investments. So that's why they're listed in both places. Now this family doesn't own either CDs of less than 1 year or CDs of over 1 year. That's not to say those aren't good products or a good place to put your money. They just don't happen to have it. Mutual funds. And we have a chapter on mutual funds, and we'll talk more about them when we talk about investments. They own those. It says real estate. It doesn't list anything in there. So just remember that. We'll come back to it. Retirement funds, IRA, it says 2000. Now, just so you know, retirement fund is a type of account, or isn't, it's a generic term for a type of account. And an IRA is a specific term for a specific type of retirement account. Now, within those accounts, you can have stocks, bonds. You could either list, they could have had everything in their retirement account, or they could have simply categorized the things from their retirement account as stocks or bonds and not had a category for a retirement account. Either way would have been fine. Any other investments they might have, they don't have any. And you see they subtotal each subcategory. So they have a total for liquid assets, a total for investments. Then we get down to real property. So what are they talking about here? This has here listed a primary residence, where they live, a second home, and then other property that they might own. So why do they have a category for real estate under investments, and why do they have a category under real property, and why did they put their house under real property and not under real estate and investments? So think about that for a second. And the reason is, what's the primary purpose of the home they live in? Yes, they would like it to go up in value. Yes, it could go up in value and they could make money off of it. But the primary purpose of that residence is for them to live in. It's not, the primary purpose isn't as an investment. If it was as an investment, they would probably be renting it out. It would probably be some form of rental property. So that's why it's in this category and not up under investments. Okay. Next, personal property. It's just all the other things you own, all the other tangible property, like cars, like clothing, like jewelry, like furniture. The list could go on, right? And you could subcategorize that as detailed as you want, or you could just have cars and other personal property, like whatever's going to be most useful to you in your financial plan. Okay, then we total all the assets. That's at the bottom of the left-hand side of the page. So it says total assets. They have a total in assets of $218,475. Now, moving over to the right-hand side of the page, up at the top, it says liabilities and net worth, and it says current liabilities. This is a subcategory for liabilities, and you can call it either current or you could call it short-term liabilities. They both mean the same thing, and what they mean is anything you owe within the next year. This is money you owe within the next year. And so think about the things you have to pay over the next year, and those can include utilities, it can include rent, it can include insurance premiums, which is blank for this family, and that should cause a red flag. Wait a second, they own a home, they own 2 automobiles. Why don't they have any insurance premiums? So something seems wrong here, like they made a mistake or forgot to record that. What about this next one? Taxes, right? Again, there seems to be something wrong here. They own property. They should have property taxes. They have income. Well, we don't know if they have income or not, but they own property. There's something, they're missing something there. But that's fine. Look, I mean, you would just fill it in, and you can make mistakes on these, and then you have to go back and correct them. Medical and dental bills they have coming up over the next year, they think will be $75. They don't expect any repair bills. They have bank and credit card balances, department credit card balances, travel and entertainment card balances. Just remember those. We're going to come back to them and we'll talk about it. Gas and other credit card balances. Same thing for that one. Bank line of credit balances and other current liabilities. What are some other things you could see in here? Well, you might have a student loan, and if you have to make payments on it over the next year, that would be included in here. This house, these people have a home. Do they have a mortgage? Well, if they have a mortgage, don't they have to make payments over the next year? And so here's another area it looks like is an error, okay? Next, long-term liabilities. This is what they owe over a future time period. And so over any money they're going to owe that isn't going to be paid off in the next year. Okay. And so things that will also come in here are a mortgage. Now the mortgage can show up in both places, because if you're not going to pay off your mortgage in the next year, you need to list it down here in long-term liabilities. But you also have to make those payments over the next year. And so you should list all those. If your mortgage is $1,000 a month, then what should go under short-term liabilities or current liabilities? It should be $12,000, right? If your rent's $1,000 a month, you would put $12,000 under rent. What about mortgage? A mortgage will show up under long-term liabilities. Now, do you have to, if you're renting, do you have to put how much you're going to pay in rent for the rest of your life? No. It's just money you've actually borrowed under long-term liabilities. Under short-term and current liabilities, you can actually put, it's not just money you borrowed necessarily, it's just everything you have that you have to pay over the next year, right? So it could be bills, it could be other things. Okay, so long-term liabilities, moving on. Mortgage, a second mortgage, a mortgage for an investment property, automobile loans that aren't going to be paid off within the year. Again, don't they have payments on those? The payments over the next year should go up under current liabilities. Appliance and furniture loans. Now, those might not have payments over the next year. Sometimes they'll be like no payments for a year, and then you just pay it all at once. Home improvement loans, single payment loans, education or student loans, right? These are all things that can show up under long-term liabilities. Anything that's not going to be paid off within a year. Now notice there's no space for credit cards. Think about it. Does everybody pay off their credit card within 1 year? The answer is no. So you might think, okay, well, if someone isn't planning on paying off their credit card, well, then they put part of it under long-term and the other part of it under short-term. The answer to that is no. That's not how you do it. So what you want to remember about credit cards is that your entire credit card balance, the entire thing, whether you're going to pay it off within 1 year or not, goes under short-term liabilities. Why is that? Well, the reason is you should pay it off within 1 year. You really do not want to keep credit card debt longer than you need to. You don't even want it to go past a month. Why? Well, because if you let it go past 1 month, you have to start paying interest on it. And credit card debt is some of the highest interest rate loans that there are out there. They're only superseded really by payday lending, which is something you want to avoid unless it's an absolute dire emergency. Credit cards, the entire balance goes up under short-term or current liabilities there. So remember that, and that'll help you out in the midterm. And okay, so how do we record things that show up under short-term and long-term liabilities? Now, normally if we were in class, I would demonstrate how to do it. I'm going to briefly just talk about it here, but for this mortgage, let's say today is December 31st, 2012, and they're doing this balance sheet. December 31st, 2012 is right now today, and they owe $160,000 on their home. If they wanted to pay it off, that's how much they would pay off. Well, then they shouldn't put $160 in total under long-term liabilities. What they should do is put their payment, let's say their payment is $1,000 a month, they would put $12,000 under short-term liabilities. And then under long-term, what do they put? Do they take $60,000 and subtract 12 and then put that? No. And why not? Think about it real quick. Some of you will get it. And the reason you can't do that is because what we're going to put down is the balance at the end of this year after making those $12,000 worth of payments. What will be the loan payoff amount at the end of the year? And it's not going to just be 160 minus 12. Why not? Because they're going to pay interest on that loan. And so part of their payment is just paying interest. It's not paying off the loan. And so what you have to do is calculate what the loan balance is at the end of the year after you make those 12 payments of $1,000 each. And it's actually really easy to do if you have a program like Excel or you have a financial calculator. And we're going to go into how to do those kinds of problems in the next chapter. You know, maybe come back and refer to this balance sheet again after you've seen that. Okay. All right. So that's how you would do it. You would record part of it in short-term liabilities, part of it in long-term liabilities. Then you get a total for each of the current liabilities and the long-term liabilities. You add those together and that's your total liabilities. Now we have total assets, we have total liabilities. We take total assets, we subtract total liabilities, and whatever's left over, if there is anything left over, you know, it could be zero or it could even be negative, but hopefully it's not. Hopefully it's positive, and that's the amount, that amount that's left over is our net worth. Another way to say that is if we took everything we owned, we sold it, and we paid off everything we owed, what would be left over? That's net worth. It's a measure of your wealth. And so in some cases, like when I was in college, I actually owed more than I owned. And for me, that meant I had a negative net worth. And that might seem kind of depressing, but at the same time, and that's true for many college students, you know, they might have borrowed money to go to school. They don't have a lot of assets maybe. And so when they do a balance sheet, their net worth might be negative. And again, like I said, that could be a little discouraging. But one of the things that's not captured on this balance sheet that we all have is something called human capital. And human capital is just the ability for us to monetize ourselves. Basically, it's our ability to make money over our lifetime, whether that's through working, whether it's through investing. And think about all the ways we can make money working. You could become an accountant, you could lay tile, you could dig ditches, you could play basketball. I mean, there's lots of things you could be rewarded for. You can make YouTube videos, you could be an actor or a model. So that has to do with everything about you, right? It has to do with your knowledge, like say of accounting, your skills, say as a basketball player or YouTuber, or talent, or even your looks. All of that stuff can be monetized and possibly turned into income stream. So that's not on here. And if it was, all of you, for the most part, would probably have a very sizable net worth if you included under assets your human capital, because your human capital is likely a 7-digit number. So we're talking of, about over $1 million or in the millions of dollars. What's the present value of all of your work over your entire lifetime? It's if you could take your salary for everything you're going to do for the rest of your life and get it all right now today, what would that be worth? So, we don't record that. So that's just one thing to consider. And so that means you have a much better outlook than maybe your balance sheet suggests. Anyways, that's a balance sheet, right? I want you to be familiar with it. It has 3 things on it: assets, liabilities, and net worth. We subcategorize those things, and the assets, for households, it doesn't have to be these exact same subcategories, meaning liquid assets, investments, real property, and personal property. But those work really well for most households. Under liabilities, we're always just going to have 2. We're going to have like short-term and long-term liabilities, or as in this case, current and long-term liabilities. And then we're going to have net worth on our balance sheet. So that's how you do a balance sheet for a household. All right, let's move on. So it's called a balance sheet in some respects because if you take total assets, they are going to balance out or equal total liabilities plus net worth. I like to rewrite that, and that's rewritten on another slide, so we'll come back to it. Assets, we mentioned, are just things you own. Then you could list them without subcategories, and it's not like it would be wrong, like your balance sheet would be wrong. It would just be less useful. And so it is good to subcategorize them. And for most households, these are good categories. Some people, if they had a small business or something like that, they might have some separate categories. But at any rate, liquid assets, investments, real property, personal property. So liquid assets being, things that can be converted to cash quickly with little or no risk. Remember that part. We already defined that last chapter. Investments are risky assets we own that are owned in order to make money. They're there for us to make money on them. And they can do that in a variety of ways. And then real property, it's things we own for our own use that are attached to land and or are a building or something like that. Whether that's a home we live in and or a vacation home we use, that's, its primary purpose is an investment. If it is investment, then it can go under investment. And then personal property is all other property we own, other things we can touch, tangible property that we own. So clothing, cars, jewelry, makeup, anything we own, right? If it is valuable at all, it's going to go under personal property. So that's it. Moving on. Liability. This is easy. This is just money we owe, and we classify it by maturity. That's when it's due or when we're going to pay it off or when it's going to have to be paid. And so we have 2 categories. You can either call it the first category current or short term, and that's just stuff we have to pay over the next year. And then long term is any money we've borrowed that's going to take us longer than a year to pay back. One exception, remember, credit card debt, even if it's going to take us longer than a year to pay off, we're going to put it under short term, right? Remember that, right? So credit card debt always goes under where? Where does credit card debt always go? It always goes under short term, even if we're going to take longer than a year to pay it off. Net worth. So this is the balance sheet equation rewritten. Net worth is equal to total assets minus total liabilities. And I said, I tend to describe it as if we took everything we owned, we sold it, paid off everything we owed, what would be left over, if any? So if the leftover amount is positive, then we're said to be solvent, meaning we could pay off all our debt if we needed to. And if it is negative, meaning we owe more than we own, then we're said to be insolvent because we couldn't pay off all our debt. If we look at people over time, right, just think about your lifetime. What's going to happen to your net worth over your lifetime? Think about you at 12 years old. Did you have a high net worth? Did you own a lot of things? Did you owe anything? And chances are that you neither owned a lot of things or owed a lot of things. And what do you expect? And right now, think of yourself. What do you own? What do you owe? And everybody in the room would probably come up with a different number. But for most college students, just think about the average college student. Would that number be small? Would it be large? Could it be negative? Could the average number, for the average college student, do you think the average college student has a positive or negative net worth? So think about that. And then what about young people in general, say people under 35? What's their average net worth, do you think? Well, we have it here, but we have it going back quite a few years, 2009, roughly $4,000 there, right? For all Americans in 2009, it was on average $71,000. Now look at what happens to people as they get older. Look what happens to their net worth. And what do you expect to happen to your net worth over time? Think about what you're going to do in your life. Now, you might borrow some money to buy a home initially, to buy a car initially, but you're going to pay those loans off over time, aren't you? So those loans are going to go down in the amount you owe over time. And what's going to happen to the money that you're saving, to your investment portfolio? What's going to happen to that over time as you get older? Well, hopefully what's happening is that it's going up in value, or you're saving more over time until you get to retirement. And then what happens to those investments and the money that you have saved and accumulated over your lifetime? Well, at that point, for a lot of people, they start spending that in order to replace the income they were receiving when they were working. If they're in retirement, they're no longer working, or maybe they're working part-time or something, but not as much as they used to. And so that amount could go down over time. But you see here it actually goes up slightly, but that's going to depend on a household by household basis. But anyways, you get the picture, right? So over people's lifetime, their net worth tends to increase over their lifetime. Or if you took people that were older, on average, they would have more wealth than younger people on average. Obviously, you can find examples of fabulously wealthy young people, right? Just think of any iconic entertainment star, whether they are a musician or an actor or a athlete that is very young, maybe who's not even an adult yet, and compare them to somebody with very little wealth that's 70 or 60 or whatever age. That young star is going to have a lot more money, obviously, right? But we're talking about on average for most people. What's the arc of their net worth going to look like? Okay, the balance sheet is assets minus liabilities, which equal net worth. And an example, let's take a look at what happens if someone buys, or someone's stock portfolio increases by $3,000. So how would this affect the balance sheet? So how would someone's stock going up affect their balance sheet? Well, what will happen is their assets will increase. Which assets specifically will increase? Their investment assets. By how much? $3,000. If that's the only thing that changes, right? Just their stocks went up by $3,000. Will that affect anything else? Yes, it will. So let's say that's the only thing that happens, then their investment assets will go up by $3,000, which means total assets will go up by $3,000. Liabilities stay the same because we said everything else stayed the same. And then when you take assets now, total assets, which have gone up by $3,000, and you subtract liabilities, what you're going to wind up with, which is a net worth that increases by $3,000. So their net worth will have gone up by $3,000. So now this seems pretty easy, right? But it is also easy to make mistakes if you don't think about these things carefully. So when you're doing homework assignments, if you have accounting classes later, if you're an accounting major or a finance or financial planning major and you're doing this on a day-to-day basis, you just have to be careful. It kind of comes with practice too, just having attention to detail, and so that you don't make a stupid mistake. And so that's how they would affect the balance sheet here. Another example affecting the balance sheet. How would a client buying dinner on their credit card for $500 affect their balance sheet? Assets are not going to go up. If you buy a dinner, right, it's not like it holds its value. You can't resell it or anything, at least in all normal circumstances. You just eat the dinner and, that's it. So you bought dinner on a credit card for $500. So your assets don't change. They don't go up, they don't go down because you didn't use assets to pay for it. You borrowed to buy the dinner. So what does go up is your liabilities go up. Your liabilities go up by $500. So your assets didn't change. Your liabilities go up by $500. Now you're subtracting an extra $500 when you take assets minus liabilities. What does that mean to your net worth? Your net worth goes down by $500. So that's how it would affect the balance sheet. That's how it would affect net worth. All right, moving on. Examples of how things impact net worth. Let's consider buying a car for $40,000 with a down payment of $5,000 in cash. Now, this is also simple, okay? But many people will make mistakes, especially the first few times they do this problem. All right, so let's work through it. What will happen to us? Well, now, there's some caveats here, but the answer can be that there is no immediate impact on net worth, okay? Meaning our net worth doesn't change at all. And you might think, how could that be? And you might be thinking of it for the right or wrong reasons. And we want to think about the right reasons why it could have an impact on net worth. And so we'll come back to that. But let's work through it and see why it might not have an impact on net worth. So we used $5,000 of cash, right? So that cash is gone. That means liquid assets goes down by $5,000. That means total assets would go down by $5,000. But we acquired an asset. What asset did we acquire? We got a car. What's the car worth? $40,000. So personal use assets goes up by $40,000. Therefore, we spent $5,000 of liquid assets. Those go down by 5. Personal assets go up by 40. So total assets goes up by $35,000, right? Because we have this car that's worth 40, even though we spent 5,000 of our liquid assets. So total assets goes up by 35. Now, where did we get the rest of the money for the car? We only used $5,000 of cash. We need to pay for the rest of the car. We borrowed it, right? So our liabilities go up by $35,000. Our liabilities go up by $35,000. So our assets, total assets went up by $35,000. Our liabilities go up by $35,000. $35,000 minus $35,000 is 0. Okay. Now, this is the way I did this problem is just to make it simpler. But in reality, some of you might be going, aha, but what about the fact that the car goes down in value? I bought the car for $40,000. If you bought a car for $40,000, could you sell it to somebody else for $40,000? Probably not in most cases. In most cases, you would have to sell it for less. As soon as you drive it off the car lot, it's less valuable. And so cars start going down in value, right? They depreciate. And so what that means is we would record the car at something less than $40,000. Let's say, I don't know, $38,000. And that means total assets would only increase by $33,000, but liabilities would increase by $35,000, and our net worth would go down by $2,000. And this is why I mentioned before, we want to try not to borrow for things that go down in value, because when we do that, we're decreasing our wealth. We're decreasing our net worth. We're borrowing for something that's going to go down in value, and we have to pay it back over time with interest. And so we want to avoid this whenever possible. So you're going to be much better off throughout life if you don't borrow to buy a car. And for some people, they could make the argument they like cars so much and it's so meaningful to them to get it sooner rather than later that it'll make their life better, even though it's decreasing their net worth. Because remember, the whole goal in life is to be happy, and having an increased net worth, all things being equal, right? People would say, I'd prefer the higher net worth, but the goal in life isn't to have a high net worth, it's to be happy. And so for some people, borrowing to buy the car can still make sense, all right? But it's if you can avoid it, avoid it. You know, buy a used car, pay cash, delay getting that car if you can. And even if you are the kind of person that really loves cars and you borrow to buy your first car, you know, later on, try to pay cash for cars. You'll be better off over your life if you do it that way. Okay. So let's move on. The income and expense statement. So now we're looking at a different financial statement. This statement looks at the past. So the balance sheet looked at a snapshot in time, like a current moment in time. I guess it's in the past in the sense that as soon as it's done, it's kind of in the past. But we'll think of the balance sheet as kind of like the current situation or a current snapshot or one moment in time, whereas the income sheet is looking at the past. And you can do one of these for a whole year, and we typically do. So typically an income statement is going to be looking at last year, but you could do one for the last month or the last week or the last quarter. You can do them for any time period you want, but we'll typically at least do one for an entire year. But it can still be beneficial after that to do one for a month or every 2 weeks. Like you might do one, it could be useful to you to do one as often as you get paid or as often you as pay bills. So most of our bills are monthly. So maybe we do a monthly income statement. That can be useful, and we'll talk about why later. So the income statement, what does it have on it? It's the income and expense statement. A lot of times I just refer to it as the income statement. And remember, for our purposes, this income statement is also going to serve as a cash flow. And so sometimes in the book, you might see it shown as an income statement. Sometimes you might see it as a cash flow. And basically for us, it's the same thing. Okay. So don't get confused by that. I'll probably always use income statement as the term rather than cash flow. And also don't get confused. If you take an accounting, don't go to your accounting class and say, Professor Vazani said income statements and cash flow statements are the same thing. Because if you're doing accounting and you're doing how most businesses do it, an income statement and a cash flow statement is not the same thing. I'm not saying that they're always the same thing, okay? For our class, they're the same thing, all right? So don't get confused by that. If you're an accounting major, your income statement and your cash flow statement is going to look different, 99% of the time. In this class, it's simpler. Our income statement and our cash flow statement are going to be the same thing, okay? So what does an income and expense statement have on it? Well, there's 2 clues right in the name. It has income on it and it has expenses. And it's for the last year, so it has it for the last year or for whatever time period you're doing, like the last month, in this case, a year. And then you subtract expenses from income, and that gives you a surplus or deficit. Okay. So what sources of income can we have? Well, think about all the ways you can make money. Well, that's your income, right? So you can make money from wages, salaries, bonuses and commissions, interest and dividends, child support, tax refunds, gifts, royalties, residuals, rent, dividends. Okay, so these are all different ways we could make money. We might be able to think of a few more, but the list doesn't go on forever, right? This is a pretty good list. It lists most of the things that are going to give us money. So it's just sources of cash. So if we're talking about cash flow, we mean cash coming into us. And so we're going to list that on our income statement. Okay, the next thing an income and expense statement has, surprise, is going to the next slide. Expenses, cash going out or cash flow out. And look, we could make a list, goes on for infinity. There's no end to things we could pay money for. And so, we could list expenses all day long. You know what your expenses are. And just like on the balance sheet, we might subcategorize things. Now, most people won't have a ton of different sources of income. Maybe they'll have income from work, like a salary, and then they'll have investment income or something like that. But outside of that, they probably don't have 30 different sources of income. Most people. But expenses, they'll have easily probably 30 expenses or more. You could have several expenses, and it can be good to categorize them. And there's different ways to categorize them, like this: living expenses, tax payments, asset purchases, other payments. I don't find that super useful, but it could be useful for you. It's whatever's useful for you. Moving on. Another way to categorize expenses as fixed or variable, and you could keep those same categories on the previous slide and then put just a little F or a little V by it, right, for fixed or variable. But I don't prefer fixed and variable costs. You can think of fixed costs like things that don't change. So Your rent probably doesn't change from month to month, whereas your utility bill is variable. It can go up or down. I don't find this as a category very useful, but I do find the term discretionary or non-discretionary, right? So discretionary expenses are expenses that you could live without, right? They're things that you paid for over the past year that if money was really tight, right? If you really had to, you lost your job or something, what would you stop buying? Like, you might stop buying music, you might stop paying for HBO. There's all kinds of things you might stop doing if you became unemployed. You might stop going to movies. Those are discretionary expenses. Non-discretionary expenses are things you have to pay. You don't want to be homeless, so you have to pay your rent. You have to pay your utility bills because you want electricity on. You have to be able to eat, so you got to pay for food. Those are non-discretionary expenses. Those are categories I find very useful. So you could label each expense with a little N by it, or ND for non-discretionary, or a D for discretionary. And that can be useful, and you'll see why later. So that's another way to label expenses. And that's the one I would suggest, discretionary, non-discretionary. Moving on. All right, so here we have a statement of income and expenses for Mr. and Mrs. Zacher. This is for 2015, so it's for the entire year. You can do one of these for a whole year. You could do one for a month. You could do one for 2 weeks. They all could be useful, okay, but we'll typically do one for a year. And so typically they're done like at the end of the year. So this is for, say, like the calendar year 2015, right? It starts off with their income. It lists their income, and for them, they just have their salary, right? So Mr. Zacher made $58,000. Mrs. Zacher made $100,000. Total income or total cash inflows, because remember this is doubling as a cash flow statement for us, is $158,000. Next, we have expenses, and we subcategorize these. And so let's just go through those categories real quick. You could have different categories. It's whatever's useful to you. You don't have to have these categories, but these are categories most households will have. And so they have savings, debt payments, living expenses, insurance payments, taxes. Those are the subcategories they used. Now, you might think, well, that savings aren't really an expense. It's just my money. Why am I listing that as an expense? And that's simply because this is doubling as a cash flow. We're just showing what we're doing. We got this cash coming in. What are we doing with it, right? We got this cash coming in from our salary. How are we allocating that money? Are we saving it? Are we spending it? So that's why it's labeled under here as an expense, again, because this is doubling as both an income statement and a cash flow, okay? Just get used to that we're listing savings as an expense, and that's fine. So what do they have here under savings? They have contribution to Mr. Zacher's 401k plan of $5,000, a contribution to Mrs. Zacher's 401k plan of $10,000, a contribution to their IRA account of $5,000, a contribution to a 529 plan for their kids, that's a college savings plan of $8,000, or I should say now an education savings plan, because you can use it for either private tuition at let's say a private high school or elementary school, or you could use it for college. Okay. Why do people make contributions to these plans? It's because they're tax advantaged, meaning they save money on their taxes if they make contributions to these plans. And if you save money on taxes, that means you get to keep more of your money. Most people like to keep more of their money if they can. Most of you would like to keep as much of your money as you could that you make. And so you'll likely use these accounts. If you're not using them now, in the future, you'll likely use these accounts. We'll talk more about these plans when we talk about investments and retirement, and just kind of throughout the semester, you'll hear them come up. If you're not familiar with them, that's fine. You can look them up. Feel free to look them up ahead of time. That'd be a great thing. I will just mention a 401k plan is through an employer. You might have heard of them. Many of you will already know what one is. Besides the taxes, are there other reasons people save in these? Yes. With 401ks, a big reason people put money in a 401k is the employer might match, meaning if you put in $1, they might put in $1. Or if you put in $1, they might put in 50 cents. Like they might put 50 cents on the dollar, or $1 per dollar they might match. It just depends. They might not match at all, okay? So why would an employer, match the money you put in a retirement account? Do they really, do they just care about your retirement a lot? I don't know. Hopefully some employers do. That might be a little optimistic of me to think that some employers want their employees to have a good retirement, but they don't even have to want that. There's some other reasons why they do this, okay? Okay, one is the government. The government encouraged this behavior. How does it do that? Well, most people that own a business would like to retire. They would like to save money on the money they put away for retirement. But the government says, hey, if you want to have a great retirement plan for yourself, you have to, and your other executives, let's say, you have to set up a plan for your other employees and so that they have a retirement account. But that's not enough. You can't just set up a plan and then start your own plan and save a bunch of tax money, because you could start up a plan and either discourage people to use it, not publicize it very well so your employees don't know about it, right? Like if you did that, you could benefit from having a great plan for yourself, but your employees don't benefit, which is what the government wanted to get done. They're encouraging you to set up a plan for your employees so that you can have the plan for yourself, and there's a reason behind that, and we'll talk about that in a minute. So this is why an employer might match money in your 401k. It's because they want to get you to participate in it. And so the best way to get you to participate is say, hey, we'll match, meaning, if you put in $1, we'll put in $1, or you put in some money, we'll put in some money. Right? That's a good way to get people to participate, because it's money you wouldn't have got, or you're not going to get, if you don't participate. So that's a great reason to participate. Even if the government didn't encourage businesses to do this, they might do this. Why? Like I said, they might care about their employees. Hopefully some companies do, but they don't even need that. Okay, they might do it because they want to attract the best employees, and smart employees will care about a retirement package that's offered from their employer, and a retirement package that matches what they put in. They'll value that, and it will also help keep those employees, retain those employees, so they don't go to other companies. So some companies would do it even if the government didn't encourage them. I'm not saying the government shouldn't step in or doesn't need to step in. I think it is very useful for the government to have these rules around retirement plans. If you want to learn a lot more about that, we have a whole class on retirement planning. And if you're going to be a business owner in the future, if you want to own your own business, it's a great course because it goes into much more detail around all of the rules and regulations regarding setting up these accounts for yourself, right? For a small business owner, for your employees, right? So you can have the best plan for yourself, so you can have the best plan to attract and retain employees, etc. So that's retirement planning. If you're a financial planning major, you'll be taking that course. And if you go on to work as a comprehensive financial planner, you'll be working with business owners on setting these plans up. If you learn these skills, that's very valuable. And it's knowledge that is very valuable to those owners, and they're willing to pay you a good amount of money to do that. So now that we've said that, why does the government care about your 401k plan, right? Why does the government care if you can retire? Well, the government cares because when you get older, right, you might lose the ability to work. You might have cognitive decline. You could become physically unable to work because of declining health or degenerative arthritis or any number of age-related diseases could rob the ability you have to work. And we have an elderly population that is unable to work with no income, and they become destitute and homeless. People aren't going to like that, right? You don't want to have a bunch of destitute elderly people, and people are going to step in to try to help them. They're going to request that the government do it, and then the government would have to set up programs and things to assist all of this population. And so rather than doing that, they would prefer to encourage people to save for their own retirement, right? That's why the government steps in and encourages business to do this and makes these rules. Debt payment. Debt payments are self-explanatory: auto loans, home loans, student loans, etc. Living expenses, same thing. Insurance payments, same thing. And then the next one, taxes. You might think, hey, that seems weird. Taxes don't seem like, might not have included them, but those are an expense, right? Those are, it's money you don't get to keep. So, and it's good to know how much you pay in taxes, right? And so you might pay income taxes. Now, a lot of you might think you're paying income taxes, but most college students aren't paying income taxes. They are paying payroll taxes, which come out of your income. But some college students are paying income taxes, but some don't make enough money to pay income taxes. And we'll talk about that later when we talk about our chapter on taxes. Payroll taxes are for things like Social Security and Medicare. Well, what do those things do? They provide Social Security and disability benefits and survivor benefits to people who qualify for Social Security, meaning they give you some sort of income in retirement. And there are a lot of people whose only income in retirement, like my mom, her only income in retirement is Social Security. They have no other sources of income. There are people whose only health care coverage in retirement is Medicare. There are people who have lost, a parent whose income made up all of the income of the family, or whose income made up most of the income of the family, and Social Security survivor benefits replace a portion of that income. There are people who are disabled and unable to work, possibly for the rest of their life, whose only source of income are Social Security disability benefits. Now, all of these people have qualified either because they were married to somebody who qualified for benefits, they were the child of someone who qualified for benefits, or they themselves qualified for benefits, meaning they paid into Social Security, they paid Social Security and Medicare taxes for a certain period of time. We have gone over the entire income and expense statement with the exception of the last line where we just subtract income from expenses, and this gives us a surplus or deficit. There's not a lot I want to say about that. Surplus is just means our income was more than our expenses, and a deficit would mean our expenses were more than our income, right? So that's our income and expense statement. In our case, it's doubling as a cash flow, okay? And it looks at the past. Now, so we already talked about a little bit of how financial statements differ and even how the income statement differs. Obviously, an income statement for a household is going to have different categories than an income statement for a business. Their sources of income are going to be different. The other thing is we do things for a household on a cash basis, meaning we don't list things on a income statement. We don't list income if it didn't actually happen, okay? We don't list payments unless we've actually made them. And so if I did work last year and I haven't gotten paid for that work yet, I don't put it on my income statement. So we're doing things on a cash basis. So not until we get the cash do we record it on our income statement. And if I owe money on borrowed money in 2019, but I didn't make any payments in 2019, it doesn't go as an expense for 2019, okay? Because I didn't make any of those payments in 2019. So we do things that's what it means to do things on a cash basis, right? So that's how we do things for a household. And so you'll learn how to do both of those. If you go on to do an accounting class, we're not covering how to do things in an accrual basis in this class. All right, moving on. So the income and expense statement is just getting total income and then getting total expenses and subtracting it from income. And then you wind up with a surplus or deficit. Preparing the income and expense statement, you just record all your income as we showed for a chosen period, typically a year, but you could do a different time period. A month. People might do more than one statement. They could do one for the entire year, and then maybe they'll do one for the month because we pay most of our bills every month. And so that could be useful. Establish meaningful expense categories, just whatever is useful to you. Subtract total expenses from total income and you're done. It's pretty easy, right? That's an income and expense statement. One of the things we can do with this statement, especially if we've entered it into something like Excel or some other sort of software program, like a financial planning software program would do this. If you use something like mint.com, you could do this, something where you can put all your bank data in and keep track of your expenses. And that is do a graphical representation of how you spend your money. And this could be useful, especially if we are having a cash flow problem, meaning our expenses are more than our income. And so we have like a budget problem. We need to save some money somewhere. Well, then we could look at this and go, hey, I can't do much about my housing. It does make up a big part of my expenses, but might be impractical to move, and moving it costs money too. But I don't know, maybe I look and, man, I didn't know I was spending that much money on food. Could I cut back there, right? Or I don't know, health, entertainment. Maybe I could cut some expenses there. In insurance, maybe I could look how much, 11% of my income goes towards insurance. It's not like that makes me a lot happier buying. I want to have as much insurance as I need, but maybe I could shop around for insurance and reduce my rates. Different things you could do, and you could get ideas from looking at a graph like this. So it could be helpful. and that's why we might do it. This is just a graph of showing people's spending over their lifetime. Okay, and the graph starts at 15 years old, right? So it's labeled there on the left, 15. And then you see over on the right, it goes to 75. This is looking at someone's lifetime. And so you could imagine it going all, as far back as age 0 and as long as you live, right? So if you want to take that out to age 100 or however long you plan on living, think about yourself at 15. Did you make very much money? Well, you might have, right? And that's kind of why this graph starts at 15. In some states, you can start working at 15. Some states, younger, and some people might start working like a paper route or getting an allowance earlier than that. But, probably most people don't start working before then. And so maybe you start making some money, right? But at 15, most people aren't supporting themselves. They're not paying for all of their housing or all of their food or all of their education expenses, right? And so their consumption is higher than what they're spending. And so their consumption is that line where it says C, and it's a straight line, but it's sloped upward. You see a C on the left and then a C on the right, right? And it's a straight line connecting one C to the other C. Consumption meaning what we spend money on, whether it's rent or food or clothing or entertainment, whatever we spend money on, cars, vacations, that's consumption. Okay. Now, think of someone at age 25, 26, right? Now they're probably supporting themselves. Okay, do you plan on making as much money at 26 as you do at 35? Well, probably not, right? And this Y curve, it starts off on the left-hand side at a kind of a lower point on the graph, and then it's sloped upward, and it keeps going up until you get to that point H, and then it starts sloping downward, right, until you get over on the right-hand side, and you see the Y on the right-hand side, right? So you have this curved line for our income curve, because typically what happens to our income over time is it goes up as we age, okay, until a certain point in time. And that certain point in time in this graph is age 65. And what do a lot of people want to do at age 65? They want to retire. So they retire at age 65. And so they no longer have income coming in from work. But does that mean they have no income? No. Most people that are retired have income. Where does it come from? Well, it might come from Social Security, but it also could come from what? It could come from their savings or investments. And so you could pull income from there, and you could call that dis-saving, right? You're doing the opposite of saving. You're spending your savings. Another thing, like borrowing money, we could also call dis-saving. And so that's shown on the left-hand side. And so if you look at between 15 and 25, we have income that is less than our consumption, right? That Y line is below the C line. Well, if we're going to consume at the C line, but we're only making something at the Y line, how do we get the money for the rest of that? Well, we might borrow, like, people in college. A lot of people borrow money to go to college. Okay, and it'd be best if you could avoid that. If you're in a situation where you can avoid that, you should avoid it. If you can avoid borrowing to go to college, you should. If you have to borrow money to go to college, I think that's fine. I think if you're borrowing money to go to college, you need to think even more carefully about someone in college than someone that is not borrowing to go to college, because you're going to have to pay that loan back. That loan is going to stay with you for the rest of your life. You have to pay it with interest. So you really have to carefully consider what your college is going to do for you, what it's going to mean for your career, and you have to think about your career carefully and whether it's going to give you the income to pay back your student loans without causing you too much pain. And so and then the other thing is, if you do get student loans, remember, you don't have to take all of the entire amount that you get awarded. You can always take less. If you can get by with less, you should try to get by with less, okay? And we'll talk about that again when we talk about loans. Okay, so that line, but that area, the light gray area between Y and C there, and represents this person borrowing money until they get to that point A. Now they're making as much money as they're spending. And then they start to make more money than they're spending. And that's represented by the darker gray area under that curve. And that's savings. They're making more money than they're spending, and it's savings. Now, We could do things a different way. Instead of spending at that C line, right, which is almost constant, it's kind of going up over time, but at a slow rate. We could spend on the Y line. That's another way we could do things, where we have very little to spend on the left-hand side of the graph, and we have a lot to spend in the middle of the graph at age 45 around the H area, and then very little again over at age 75. But most people don't like those wide swings in consumption. It's not like you want to go from a $500 apartment a month apartment to, a penthouse when you're 45, and then go back to, a small $500 apartment you're not going to get a $500 apartment in New Jersey, I don't think, unless you're sharing it with somebody. So I went to grad school in Lubbock, Texas. You can get a $500 apartment there. So you'd have to move back to Lubbock, Texas. And even if I'm 75, me personally, I don't want to move back to Lubbock, Texas. Anyways, this life cycle hypothesis of how we consume and spend our money is just trying to graph out and show on average like what people do and how people behave in terms of their income and their spending behavior. And this graph is showing us that we like to smooth consumption over time. And why do we say smooth consumption over time? It's because if we followed that Y curve, our consumption would be erratic. It'd be very low on the left-hand side when we're young, and then it would be very high at middle age, and then it would be very low when we're old again. And instead of doing that, we borrow when we're young, and we spend our savings when we're old, so that we can have a relatively constant or smooth consumption pattern, right? That's all that's saying from this slide. Vertical analysis. Well, we've done our financial statements. At least we've done two of them, right? We've done our balance sheet. We've done our income and expense statement, which doubles as a cash flow statement. Okay, so we've done two financial statements. What can we do with those things? Well, we can do all kinds of things. One of the things we can do is vertical analysis. What is that? That's looking at just the data from 1 year, let's say, and doing some sort of analysis with that data. In this case, the data is coming from our income and expense statement. And we took our cash inflows and we said, and we separated, they're separated, husband and wife, and shows that Mr. Zacker's income makes up 37% of their income, and Mrs. Zacker's income makes up 63% of their income. Not super useful, probably not why this vertical analysis was done. What's more useful is these cash outflows. Okay. You see savings as a percentage of what? As a percentage of their income. So they're saving 3% of their income towards their husband, towards Mr. Zacker's 401k, 6% towards Mrs. Zacker's 401k, 3% towards IRA, 5% towards this education plan. In total, their savings is 17.71% of their income. This is primarily why they've done it, is for this figure. They just want to, it can be useful to see how much of my income am I saving, right? And in this case, they're saving almost 18% of their income. Now, some of you might think, oh, that's really high. I've had students that say, oh, that's really low. In general, think about what the average American might save. Now, I actually don't have that data. It wouldn't be too hard to get. We could get, there's studies that look at things like that, and, they take a sample, and so we won't know exactly, but we'll have a really good idea from, you take a random sample of people and look at how much they save out of their income. That's going to come close to, what the truth is for the entire population. The bigger the sample, the closer you get to the truth because of the law of large numbers. But anyways, if you thought of that, I know, I don't know what it is exactly. I know that this is more than most people save. So if you thought it was a little, well, then I guess that's good, because you might have a propensity to save more. And in general, I think a propensity to save more will serve you better in life than a propensity to save less and spend all of your money, right? Like, I think you could see that. I think most people will have a harder time saving money than spending money. And I think that's reflected in the fact that, more people do have a problem spending money than saving money. There's not a lot of people that save too much money. There are some. Every once in a while, you'll hear about, like, a postal worker, right? A postal worker, do they make a phenomenal amount of money? No. So you'll hear about a postal worker that never received a big inheritance, right? They've been a postal worker their entire life, and they accumulate some, stupid amount of money just by saving and investing, right? And how did they do that? I don't know. They there's a couple stories that have come up in the news like this. You might not have ever heard one, but you might in the future. Like in the story usually goes that this person ate the same lunch every day, their entire life. So it's just, they were very, very frugal. Maybe they had peanut butter sandwiches on stale bread every day and scrimped and saved every penny they had. And if you do that and you have a good investment plan, you can accumulate millions of dollars, even if you don't have a super high paying job. I would say, that person probably saved too much, because imagine your life doing that, right? Doing that, at 20, at 21, at 22, at 23, at 24, living that very frugal life, and then getting to retirement with like $7 million, whatever the amount is. Okay. Yeah, you could have a great retirement. Sure. At, whatever age you retire, 65 or 70, but like, and what can you do with that money? You could go on vacation, you can go jet skiing, but I don't know about you. I'd rather be in the Bahamas jet skiing at 22 than at age 67. That's just me though. So I would say that person saved too much money. Now, I wouldn't worry about saving too much money. Don't lose sleep saving too much money. Don't go, hey, Professor Verzani said we shouldn't save money, right? Most of us have a problem saving money, and we save too little, okay? And so we need to think of ways we can save more. Is this the right amount of money for the Zackers to save? I don't know. I can't tell you with this amount of information. All I can tell you is it's more than most families save. But I can't tell you it's the right amount for the Zackers to save. I don't know how much they have saved already. Maybe the Zackers are 60 years old, they want to retire in 5 years, and they haven't saved a dime yet. And they want their retirement to be great, and they want to go on vacations and buy cars every few years. Well, then this might not be enough money, right? I don't know, just based on this, right? It could be the right amount of money. It could be the wrong amount of money. I could tell you, if they're young, it's likely they're likely on track. Saving 18% of your income in your 20s, even your 30s, means you're probably well on your way to reaching whatever goals you might have for retirement, or even in this case, depending on how old their kids are, sending their kids to college with that 529 plan. Okay, moving on. Horizontal analysis. What is that? Horizontal analysis is, instead of looking at data from 1 year's worth or one single financial statement, we're looking across multiple years or time periods of data. Okay, so for example, this is information also taken from the income and expense statement, just like the last analysis was. But instead of just 1 year's worth of data, we're looking at 1, 2, 3, 4, 5, 6 years worth of data. We're comparing 2011, 2012, 2013, 2014, 2015, all to year 2010. And so what we're saying is, compared to 2010, our income went up in 2011 by 5%. In 2012, it went up by 15%. In 2013, it went up by 25, etc. Right? And so that looks great. That would be phenomenal. I don't know if you know how much income generally goes up for most people year by year, but generally it goes up by about the amount of inflation. All right? For most people, it goes up about the amount of inflation. And inflation has been relatively low during this time period between 2010 and 2015. And so a growth like this is really good. This is great. You might not think it's great, but it's good. Okay. And so that's their income. Okay. Oh, all right. So that's nice. Then you have golf expense. Now look at this. Compared to 2010, their golf expense went up by 10% in 2011, and then 20% in 2012, 30% in 2010, 40% in 2014, and then 50% in 2015. So is that a problem? We don't know from this information, but it's worth looking at. Okay. So again, we need more information, but it can help. Like, they might not have been aware of how fast how much money they were spending on golf was going up year over year. Okay. And then they look at that and go, hey, we need to make a change here. Otherwise this is, going to get crazy. And so that might be the case. I don't know if it's a problem, right? They might already know it's going to get reduced in the future. They might have been doing all of this golfing with clients and with prospective clients. Maybe that's the reason why their income went up. I don't know why their golf expense went up, and so I don't know if it's a problem or not. But we do these to look and see what's going on. This kind of gives us an alert. Hey, what's going on with our golf expense? Again, there could be great explanations for it, and it might not be a problem, or it might be a problem, right? It's just one of the things we'd look at if we saw this is, like, if I didn't know the client and why their golf expense went up so much, I might throw it out there and say, hey, what's going on here? So anyways, that's horizontal analysis, right? Looking across several statements, right, over multiple time periods. Okay, why use personal financial statements? It can help us keep good records. Okay, that's one. It can help us track our financial progress. We can do ratio analysis. We can take items and amounts from the balance sheet, or items and amounts from the income statement. We can do vertical analysis. We can do horizontal analysis, and we can do ratio analysis. We haven't done that yet. Okay, but that's, those are all things that can help us make better decisions. Okay, so a ratio analysis is things like liquid assets to short-term liabilities. That's a ratio, right? We're looking at two things in relation to each other. We're looking at, in this case, liquid assets, right? Let's just call it cash, right? For ease, right? Cash compared to all of our payments that are coming up due, right? Do we have enough cash to make all our payments? Okay. Well, it's good to know that, right? I'd want to know if I'm not going to be able to make my payments, or I want to know if I lost my job, right? How much cash do I have on hand to get me through the next year? For example, let's say I had $30,000 in the bank and my expenses were $60,000 a year, right? My rent and utilities and food and gas and all those things, $60,000 a year. Well, that essentially means I have enough cash, enough liquid assets to get me by for how long? Well, if I have 30,000 and my expenses every year are 60,000, that ratio is 30 over 60, right? Or 3 over 6, or 1 over 2. I can get by for half a year, right? So that's how we can use ratio analysis to get an idea of where we stand or where we need to be. For example, that particular ratio is a rough guide to our emergency fund. An emergency fund is how much liquid assets should we have set aside in case we face one, unexpected expenses, right? Like a big medical bill from, something like, a respiratory disease like COVID-19, okay? Or losing our job, whether it's because the business we work for shut down because of COVID-19, or because we can no longer do our job because of being in the hospital and unable to work, right? So if any of those things happen, we're going to have enough liquid assets to get by until we can get back to work, or maybe in the case of becoming temporarily, or in the unfortunate event of becoming permanently disabled, until our disability insurance benefits kick in. And if we don't have a disability insurance, maybe Social Security disability kicking in, okay? Or workers' compensation or something else, okay? So in the meantime, what do we do to get by, right? Well, we have to eat. We gotta, we want a place to live. And so we all need to have an emergency fund set aside. How big should our emergency fund be? it should be 3 to 6 months of adjusted expenses. What are adjusted expenses? So I said I had $60,000 in expenses per year. Well, if it was really simple, we would just do, I had 30,000, that gets me by for half a year. Half a year is 6 months. So I meet the definition for the emergency fund. I have 6 months of expenses. But what do I mean by adjusted expenses? This gets back to that discretionary, non-discretionary. And this is why you might want to label your income and expense statement. And if you think about it, if you lost your job, what would you stop paying for? Well, you might stop paying for HBO. You might not need to dry clean your clothes. There's a lot of things that you might stop paying for. And so cut all those expenses out, right? And now how much are your expenses per month? All right. Okay. So, or per year. Let's just go with per year. You can do it any way you want. Let's say if I cut those things out, my expenses are $50,000 per year. How big should my emergency fund be? It needs to be, 3 to 6 months of adjusted expenses. So if I want to go for 6 months, I only need $25,000 in liquid assets, right? How much do I have? I have 30. So I have $5,000 more than I need in my emergency fund. So it's good that I have my emergency fund, right? It's great. I have an adequate emergency fund, right? I have a little bit more than I need. Should I keep that money, like right now, maybe I have it in a money market account, right? I have, maybe $5,000 in savings and $25,000 in a money market account, right? $30,000, all in liquid assets. I earn a little bit of interest, but not much, okay? The thing is, I could earn more money with that if I invest it. Now, I don't want to invest it all. I want to keep, 3 to 6 months in adjusted expenses and liquid assets, but I have more than that. I have 30,000. I only need up to 25. And so what I can do with that extra $5,000 now is I can go dump that in an IRA. I could dump it in a 529 plan so I can go back to grad school, or my kids can go to college, whatever the case is, or I could just put it in a brokerage account to take out in, 10 years to start a new business or something. Right? So I could invest that money, right, and have it earn more money than whatever it's earning in interest, hopefully. So that's how balance sheets, that's how income statements, the ratios and analysis, or the ratio analysis and the vertical and horizontal analysis can help us, right? And so we can use ratios from any of those two statements we used before. And then we're still going to do another financial statement, and that's the budget. We'll look at that in a bit. So we can create ratios using information from income and statements produced to tell us more about our financial health. And one of them is the emergency fund. We just went over that. Let's go over it again. This is an important ratio. And in terms of goals, right? People have all kinds of goals. They want to buy a house. They want to retire. They want to send their kids to college. There's all these things they want. They want to have adequate insurance. Okay. Not all of those goals have the same priority, and not everybody can fund all of those goals. Meaning, some people have, like, if you think about, right, think about someone living in New Jersey. Does it cost a lot of money to live in New Jersey? Yes. Think about North Jersey compared to South Jersey. Does it cost more money to live in North Jersey than South Jersey? Yes. Okay. Think about somebody making $25,000, $30,000 a year that has to pay for their own rent, that has to pay for their own food, that has to pay for their own transportation, that has to pay for their own health insurance. How much money are they going to have left over after they pay for those things? And the answer is probably nothing. Okay. And, payroll taxes come out of that money. Like how much is going to be left over realistically? So how much money do they have left over to go towards saving for retirement? How much money do they have if they had a child? How much money would they have to save for their kid's education? And realistically, it's more important. What's more important, saving for your kid to go to college or feeding your kid, right? So, you're not always going to be in a situation where you can fund all of the things you want to fund. Look, even there's people that make $200,000 a year, right? They have all kinds of goals, right? they might not be able to fund all those goals. Those goals might be like, I don't know, getting a second home and getting a boat and saving for retirement and going on $15,000 vacations a year. Those are all goals, right? They like, even though they're making a lot of money compared to most people, if they might live in a place that's very expensive, and then they have all these expensive things that they want to do, they might not be able to fund all those things, right? And so we have to put things on priority. Well, in the list of priority, right, there are things that come before others. Like where does getting a second home come? Well, it comes after an emergency fund. Don't you guys agree? It comes after getting adequate insurance, right? It comes after saving for retirement, right? I want to have my retirement set up before I buy a second house, or before, like, at least the house retains value, but like, think about something like getting a boat. Like, it just goes down in value, right? It just becomes more and more worthless every year. And so I definitely want to have my retirement set up before I do that. But even the house, I would argue, okay? So where do these things fall? Okay, what's more important? Think about this, right? Might be a little bit harder, right? Saving for your kids' education or having an emergency fund. All right, well, we already said, feeding your kids is more important than sending your kids to college, right? And paying for your kids to go to college. Okay, and what are you going to use for food if you lose your job? All right, so having an emergency fund it's super important. It's one of the first things we want to fund. And even if you're living paycheck to paycheck, you want to do everything in your power to accumulate an emergency fund in case things go south, okay? In case you lose your job, in case you have an unexpected expense, right? You want to have that money set aside, right? So it's one of the first things that we want to do. It's one of our top priorities, okay? Having an emergency fund. How much should we have? We already said, but we'll go over it again. We're going to use this ratio. And what is this ratio? Our emergency fund should equal, go down to the equation there, it should equal our cash and cash equivalents. What is that? That's just another way to say liquid assets. If you want to just say cash, look, I'm fine with that. Like, if it's easier to think about, I would prefer probably you just think of it as liquid assets, because we've already defined it and includes cash and cash equivalents. Okay, cash equivalents are things like CDs, money markets, checking accounts, savings accounts. Okay, those are all cash equivalents. It's just another way of saying cash and liquid assets, or liquid assets. Okay, cash is a liquid asset. So liquid assets on top. On the bottom, what's on the bottom? So that's the numerator. What's the denominator? Monthly non-discretionary expenses, right? This is where, you look at your expenses and you're only adding up. Now, you could do this yearly, right? You could do it monthly. Either one's fine, okay? Monthly's fine. So we'll go with monthly. Monthly non-discretionary expenses. So this is why you might want to do a monthly income statement, right? Because most of the time we think of our expenses in monthly terms, because like our car payments, our rent, our mortgage, they're all paid on a monthly basis. Our credit card bill, our student loans, we pay those all on a monthly basis, right? So it makes sense, right? We could do an income statement on a monthly basis, and then we can just go mark all the non-discretionary items, add them all up for the month, and that is our monthly non-discretionary expenses. That goes on the bottom, okay? And so what do we want our emergency fund to be? It says, if you go down to the bullet where it says target benchmark, 3 to 6 months is appropriate. What does that mean? It means we want 3 to 6 times as much in liquid assets as we have monthly non-discretionary expenses. And so if our monthly non-discretionary expenses are $3,000, how much do we want to have in liquid assets? We want to have 3 to 6 times that. That means we want at least $9,000 to $18,000 in liquid assets, right? That could be in the bank, that could be in CDs, just in liquid assets, right? We want, if our monthly non-discretionary expenses are $3,000 a month, for our emergency fund, right, we want to have a minimum of $9,000, right? And at most, right, we want to have $18,000. Why don't we want to have more than $18,000? Because there's an opportunity cost to keeping our money in the bank, right? It doesn't earn very much. And we can put our money to work for us by investing it, and we can have a much higher return that way. That's why we don't want to have too much, right? There are people that have too much in the bank. There are people that have, $300,000 in the bank when they don't need to. There are other people that have $300,000 in the bank and it's perfectly fine. Why? Like, you might go, who the hell has, like, if they have $300,000 in the bank and that's what they should have for their emergency fund, that means their expenses are $100,000 a month. And you might go, well, who the hell has $100,000 in expenses a month? Well, there are people that have that much in expenses just because, like, they're going crazy, spending money and having a really good time. But there's also people that run businesses and things that have expenses that come up every month because of the business that add up to $100,000, even if they don't themselves have a lavish lifestyle. And there's a lot of financial clients of financial advisors who would have this problem simply because, that maybe they have like I said, they have a business. So anyways, 3 to 6 months of liquid assets, 3 to 6 months of non-discretionary expenses is what you should have in liquid assets. Okay, so that's how we use the emergency fund ratio. All right, and just a reminder, non-discretionary expenses are expenses that continue even if you lose your job. That is your mortgage, your car loan, you still need to eat, you got to pay for your lights, etc. Okay. Debt ratios, these are important. If you want to buy a house, lenders are going to look at a debt ratio and use it to help determine whether or not to give you a loan. What are these two ratios? The first one we're going to look at is the 28% ratio. This measures your current income and that is spent in relation to housing. The 36% ratio also looks at your current income in relation to housing, but adds in debt repayment. Okay. So these are used by lenders to determine if a borrower qualifies for a conventional mortgage. And so they're important for those reasons. And if you're buying a house, look, you can calculate these yourself so that you can determine, hey, maybe I should be looking for a less expensive house because I don't think I'll be able to get approved for this loan based on these ratios, right? So, why set yourself up for heartbreak and go look at houses you can't afford, right? And so these can be useful for you. Next, we're going to go into the 28% ratio and how it's calculated. Let's move on. The 28% ratio is calculated. If you look at the equation there, HR1 equals, it's calculated, the numerator is monthly housing costs, which is PD, which is an acronym I want you to know. And I didn't know this in college. I assume most of you don't know. Some of you might know. Some of you might be in real estate. But PD is principal and interest. That's your mortgage payment. Taxes, that's the property taxes you pay for owning property. And in New Jersey, it is insane. It's really big. It's bigger than most of the country. And then interest. That's, insurance. We already did interest. Principal and interest, taxes and insurance. That's PD. Okay. So what goes on top? PD. All right. What goes on the bottom? Monthly gross income. All right. So you take PD, that is your mortgage payment plus your tax payment plus your insurance payment for the month, and you divide it by your monthly gross income. That's going to give you some percentage, right? This ratio, and it should be equal to or less than 28%, right? The lower it is, the easier it is for you to obtain a loan for whatever property you're looking at, right? The closer it is, or the more it exceeds 28%, just because it exceeds 28% doesn't mean you can't get the loan. It just makes it harder. The closer it is to 28, or the greater it is than 28, the less likely you are going to be able to get the loan. And if you get the loan, the harder it is for you, the harder it's going to be for you to pay off that loan without any trouble, like, missing a payment because you need to pay for food or something else, because you had a month where your income went down because of, fewer hours at work because of COVID-19, or because of a shortened semester, like a lot of faculty are looking at, less pay for the year because of a shortened semester, right? Whatever the case is, your income went down, right? If your housing payment is a really big burden for you because this housing ratio is really high because you borrowed a lot of money compared to your income, anything goes wrong, you're going to not be able to make your mortgage payment, or you're not going to be able to make another payment. It's going to cause issues, okay? And so you want this number to be, more manageable, and so that's why you want it to be less than 28%, all right? So that's the 28% ratio. You want to know that. You don't have to memorize the ratio, like if it's on a test, right? Like this semester, like if we were taking tests in person, I'll give you the ratio. If you're doing it online, obviously you can look up the equation, right? You just have to know how to plug it in. Just like in life, right? Like when you want to do this, if you ever forget, you can look it up. I want you to know this, principal, interest, taxes, and insurance, PD. Okay, moving on to the next ratio, the 36% ratio. What is this? This is almost the same as our 28% ratio. Look at the denominator, the part that goes on the bottom. This is saying the second housing ratio, or the 36% ratio, is equal to all the stuff on top over monthly gross income. Well, the bottom is exactly the same as our former one, right? As the 28% ratio. What's on top? Well, PD's on top. Okay, we're already used to that. We know what that is. What else is on top? All other recurring debt payments, like student loans, like car payments, right? Any other reoccurring debt goes on top, okay? So once you put that right on top, you divide it by your monthly gross income, and you get this percentage, and you want it to be equal to or less than 36%. What this means is this. So just think about this for a second. What we're saying is, if let's say you do this and you calculate it and it's exactly 36%, okay? So you're within the benchmark. So that means that, assuming you have good credit, assuming you have a good history of income, right? You have, decent shot of getting a loan for this property you're looking at, okay? Now, what is this 36%? What else does this 36% ratio mean? It means that 6% of your monthly income is going to go towards housing costs, right? Your mortgage, your taxes, your insurance, and your debt payments, right? How much of your income is left over? Well, if you're using 36% of your income, then what's left over, right, is going to be 54%, right? So let's see, is my math right? 64%. My math was wrong. All right. So, right, 64% of your income is left over. And you might go, hey, 64%, that's still a lot of my income, right? Well, not so fast. Let's move on. Look at this, okay? This is why we want to stick to these ratios and even be lower than these ratios if we can, okay? Think about somebody making $250,000 per year. And you might go, look, man, if I made $250,000 a year, I wouldn't have any problems. Just give me $250,000 a year. I'll be good, okay? Believe me, you'll find a way to spend all of that money and more, okay? Like, there's plenty of people making $250,000 a year that owe too much money for their income. Like, they've spent more than they should, and they've borrowed more than they should, and they have a problem paying all their bills, right? It's just a reality, especially if they live in some place like New York City or New Jersey, where it's very expensive to live. Plenty of households that make $250,000 a year, and you might look at them and go, they don't look like they're making a ton of money. And that's just because, money doesn't go as far here as it goes in other places. Now, I mean, as a single person, it would be, that is a lot of money, $250,000. But look, again, let's say, okay, so you might say, hey, I would have no problems, but check this out, right? We're making $250,000 a year. Our marginal tax bracket is 40%. Okay, so Um, Now, we're going to get into tax rates. This is a little misleading. Like, I didn't create this slide. We're going to work with it. Let's say, instead of saying our marginal tax bracket, let's say our average tax rate is 40% because that's easier. Or that's more, it's not easier, it is more correct. Otherwise, this slide is wrong. If it says the marginal tax bracket is 48%, 40%, and then it works this stuff out, it's just wrong. So you wouldn't like you might not know what marginal tax rate is yet. That's fine. We're going to go over it. So you might say, hey, who cares? I'm just trying to be correct. So I should have changed the slide. I didn't. That was bad on my part. The person that made this slide made this mistake. That was bad on their part. So you can blame both of us. But what it should say is a average tax rate of 40% instead of a marginal tax bracket of 40%. I'm sure you don't care. Anyways, 40% is what we're working with. Okay, so what we're saying is 40% of our money is going away because of taxes. Poof, right? 40% of that 250 we're making a year, 250K a year, is gone because of taxes. Okay. Now, I got to mention this. I'm sorry, right? You might hate these asides, but I think they're relevant. They're important. I think the conversation that's going on in this country is, and the conversation around taxes. And I'll say this, look, on both sides, right? It's bad, okay? I've heard plenty of bad, or I've heard plenty of mistakes. I've heard plenty of exaggerations. If you want to call them exaggerations, I've heard plenty of lies from Democrats and from Republicans, right? I've heard people talk about taxes, people that I like that are politicians, right? Politicians that I, voted for and I would vote for again. I've heard them talk about taxes and I've been disappointed because either they didn't understand taxes, they exaggerated, or they lied, okay? Whatever the case was. I've never heard something from at least like a prominent elected official in the highest office say that if you elect this other person as president, your tax rate will go up, 3 to 4 times. Okay. Like, there's plenty of people that are in the 25% tax bracket. Just imagine if their tax bracket went up 3 times. That would mean 75% of their money would be gone. If it went up 4 times, that means 100% of their money would be gone. If they're in the 40% tax bracket, how do we even do that? How do we tax them 120% of their money? You work and now you owe the government more than you've paid. Does that make any sense to you? Is there any way that this could be true or that this could come to pass? Is anybody going to be able to raise taxes that much? Okay, hopefully you think about that and you say, no, there's no way we'd be able to raise people's taxes to 100% so that they take home no money. There's no way we'd do that in the US ever. Nobody would support it. Everyone would be angry about it. There would, if the law passed, it would mean all the politicians wouldn't get to keep any of their money. Like nobody working would get to keep any of their money. Nobody would be happy with this. Nobody would think about passing this. It's stupid to even say it or think that it's going to happen. This was said. It not only was said, it was purposefully said and recorded as a campaign video. I won't mention names. You can check it out and see for yourself. I would say I would love to have a copy of that for an example. And if you come across it, please save it if you can save it and get it to me. It's if you watch YouTube, you might get it as an ad that comes up before whatever video you watch. That's how I saw it, but I haven't been able to go back and find the ad, like where I could save a copy of it, right? And I'm sure eventually I'll be able to, but anyways, if you come across it. Anyways, getting back to taxes, 40% of our money is gone because of taxes, okay? All right, so let's just think of our money in terms of percentage, right? If we got to keep all of our money, if we didn't have to pay taxes, we'd have 100% of our money, right? What's 100% of our money? It's $250,000, right? So 100% is 100%. If we have to pay 40% in taxes, how much is left over? Only 60%. Now, remember, how much of our money is going towards, if our 36% ratio is exactly 36%, how much is going towards housing and our debt payments? 36%. 36% of our money is going towards housing and debt payments. 40% is going towards taxes, right? What does that add up to? That adds up to 76%. Well, here's another thing the slide got wrong. I'm sorry, guys. What does that equal to? 14%. Not 15%. Even less than 15%. It's close. Look, they got it close. Man, I should have changed the slide. I'm sorry. I didn't create the slide, at least. So everybody makes mistakes, including people that write textbooks and including faculty. And I don't have much of an excuse, but I'm rolling with it. So 14%, right? So imagine that said 14%. I hope you can imagine that. That's how much of our money we have left, 14%. To pay for what? Well, we paid our taxes, we paid our housing, we paid like our student loan and our car payment. What haven't we paid for? We haven't paid for food. We haven't paid for transportation like gas or tolls, or we haven't paid insurance payments. We haven't paid we haven't paid for things like maintenance on our house. We haven't paid I don't know if we hire someone to do the lawn. Like there's a ton of things we haven't paid for, right? We haven't paid for dry cleaning. We haven't paid for utility bills, right? How much of our money do we have left to pay for all that? We haven't paid for entertainment. We haven't paid for clothing, right? How much of our money do we have left to pay for those things? 14%. That's not a lot. That's not a lot of our money left over to pay for all these things. Education, retirement savings, right? We only have we got to pay for all that stuff and save for retirement and save for our kids' education. Okay, so yeah, that doesn't necessarily put us in a good situation. So you can see that even if we meet these ratios, that we would prefer to be on the lower end of these ratios than at the highest end, right? The benchmark is 36% or less. We'd really rather be lower than 36%. Now, having said that, as far as I'm aware, everybody in my class lives in North Jersey. I haven't looked, but I just assume you guys all live in North Jersey. It's one of the most expensive places you could live in the U.S. It's really one of the most expensive places you could live in the world. Not the most expensive, but it's, relative to the rest of the world, it is very expensive, right? And so one of the things that makes it very expensive is housing. And if you want to continue to live in North Jersey, one of the things you're going to have to put up with is very high housing costs. And that probably means that your expense ratios, that your housing ratios are going to be very close to these maximum figures of 28% and 36%, especially when you're young, right? When you're looking to get your first home. It's just a fact of living in this area for most people, unless you make a phenomenal amount of money. But even then, you might want to live in a phenomenal house, right? And a phenomenal house in this area costs a phenomenal amount of money. So most people that live here are going to have housing ratios that are at the higher end, right? And so that's just something you're going to have to put up with. It's also something you might want to consider when you're on the job market, and opportunities that might come. And also remember, look, $50,000 a year in New Jersey is not the same as $50,000 in Iowa. Okay, $50,000 in Iowa is a hell of a lot more money than $50,000 in New Jersey. Personally, I don't know that it's enough to get me to move to Iowa, but that's just me. For some people, they would prefer to live in Iowa, or just that, having the extra, the lower living expenses will be enough, right? Like, um, so remember, when you're looking at other places, right, there are less expensive places to live. And look, I mean, I think it could be interesting working in other parts of the world, and that's another thing that you might want to look into as well. Most of you probably won't, but it is definitely worth looking at. Even looking at South Jersey compared to North Jersey, big difference in housing expenses, for example, which means a big difference in living expenses, and so your money will go a lot further there. Preparing and using budgets. So we've done an income and expense statement that looks at the past. We've done a balance sheet that looks at, a snapshot in time. Budgets look at the future. It's a short-term financial planning report that helps you achieve short-term financial goals. Achieving short-term goals helps you achieve longer-term goals and helps you keep on track. And that's why we want to do a budget. One of the reasons why, at least. Using budgets helps us monitor and control finances, helps us allocate income to reach goals, helps us implement disciplined spending. You guys might be have done, like, out of all the financial statements that we're looking at, these three, the one that you've probably likely already done, if you've done one, is a budget, right? Lots of you might have already done a budget. It can help us reduce needless spending, achieve long-term financial goals by, setting and encouraging us to save money, next month, next year, so that we have money when we reach retirement, because we've been doing it on an ongoing basis because we've budgeted for it. So moving on. What's the budget process? All it is looking at the future, looking at our future income, estimating our future income, looking at the future, looking at our future expenses, estimating our future expenses, right? And then subtracting income from expenses and seeing if we're going to have a problem. When do we have a problem? Like when our income is less than our expenses, right? And would you want to know that ahead of time? I would. What can you do if your expenses are greater than your income? Well, we'll talk about that. Okay, let's move on. Well, we're talking about it right now, dealing with deficits, right? Having less income than you have in expenses for any period of time. What can we do? The reality for most college students, unfortunately, is most college students that do a budget are going to be looking at a deficit, meaning their income is going to be less than expenses, right? Like, are there some people in my class that's not the case? Absolutely, right? Is that the majority of people in my class? No. Was it me in college? No. So, right, take your income, for example. Well, you might even go, hey, my income is enough to pay my rent and pay for food. I don't have a deficit. Okay, well, what about college? What about paying for your tuition? What about paying for your books? In addition to all those other things, is it enough to do all of that? Well, not for the average college student, it's not. The average college student has to rely on either savings that they did, or in most cases their parents did, or even more often than not, borrowing money to go to college, right? And so that's those are two different ways to deal with a deficit. I just mentioned two ways, right? One is we could use saving from a prior time period to deal with a deficit, right? Another thing we could do is we could borrow, right? Now, like, borrowing has its uses, but we want to try to limit borrowing, because when we pay it back, we have to pay interest. Student loan debt is definitely, you have to treat it seriously, right? It's different than other forms of debt in that it's very difficult to get rid of. We have bankruptcy laws in the US, but bankruptcy won't get rid of your student loan debt. So this debt stays with you for your entire life. At least it's not a bad thing to be borrowing for, in that depending on what you major in, depending on whether you make good use of your college experience, your time in college to do things that will further your career, right? And learn things like software and things that are relevant to your chosen career. You have access to software by going to college, and the ability to learn software through taking certain classes that can benefit you. depending on your career. If you want to be a small business owner, you can do things like taking an accounting class, a finance class. You could take, that retirement class. That you can take risk management, insurance. All of those can help you run your business. There's marketing classes, entrepreneur. There's lots of things there's professional sales classes, all kinds of things that can help you in your career, right? If you want to become a doctor, you could take lots of science-related classes, whether you major in science or not, but you could be a pre-med student. You don't have to be in order to go to med school, but you do have to take a prerequisite number of science-related classes, right? And that could lead to a very lucrative career, along with careers in engineering, most things in medicine, right? There's lots of things you could be doing with college that will earn you good money. Maybe some of you are thinking about going into nursing, right? That has really good income, and there's good outlooks for that in terms of jobs, right? So there's all kinds of things you could be doing that college could lead to, and that you couldn't do if you didn't go to college, right? And so it can absolutely be worth borrowing money to go to college, if that's if that's one of the only ways you can do it. Look, everybody, if they wanted to avoid student loans, they could, if they couldn't afford to pay for college, which is going to be, most people, all at once, right? They could work and save money. But that's not necessarily optimal, because you can't get the same jobs in all cases without going to college that you can get with after college jobs, like being, a doctor or a lawyer or several other things that require some amount of college, right? So it could be optimal in many cases to borrow to go to college. So borrowing money to go to college isn't a terrible thing, right? It's just that it has to be taken seriously, and you want to do as little of it as possible. So whatever you can do to reduce the amount you borrow, whether it's working part-time, getting scholarships is even better, okay? Applying for financial aid to get grants that you don't have to pay back, right? All of those things, very important, right? And there's almost no better time that you could spend as a student than applying for scholarships and applying for financial aid, okay? Really, before, if we were super rational, and I wasn't in college, I applied for financial aid. I applied for far too few scholarships. I will say this, the only scholarships I remember specifically applying for, I got. There might be some, I probably forgot some that maybe I didn't get, but it was at least an 80 to 90% success ratio with applying for scholarships, okay? So, apply for financial aid, right? Apply for scholarships. Most scholarships are going to be in the range of $2,500, $5,000, if not more. And, they might take you 20 minutes, an hour to do. Well, I don't make $5,000 an hour. I'm pretty sure most of you don't. So that's a really good use of your time, okay? So apply for scholarships. Now, so what can we deal to do with deficits? As a student, you can apply for a scholarship, right? After school, I can't apply for a scholarship, but I can borrow, right? I can use savings. I could sell an asset, right? I could sell a car or something, right? I could I could sell an investment asset, right? I could try to increase my income, right? I could try to increase my income. How could I do that? I could ask for a raise, right? And get laughed at by the dean. And what else could I do? I could, especially right now, because the whole country is kind of hurting in terms of this recession, and the same goes for William Patterson. William Patterson isn't in the best shape in terms of finances, and so yeah, I would probably be laughed at by the dean. Okay, and then what else could I do? I could get if I worked an hourly job, or even with the job I have now, I can do things like take on an extra research project and I might get summer research funding. I could teach summer school um, that I'm not obligated to teach and earn more money, right? If you worked hourly, you could pick up extra shifts, right? You could get a second job. There's all kinds of things you could do to try to earn your income. If you were in sales, you could try harder, right? Like, why not just try harder? If it was that easy, I mean, everybody would. If it was that easy to make extra money, everybody would do it. You know, those things are harder. I would say the smartest thing to do is not necessarily get a second job, right? Or work more hours. Um, the best thing you could do is either try to get a raise, a a promotion, right? Those things are gonna, because if I can work 40 hours and make the same amount of money by getting a promotion, so like I want to go to 40 to $60,000, right? I could get there by working two jobs and working 70 hours a week, or I could get there by maybe getting a promotion, right? The smarter thing to do, or the more efficient thing to do, is to get the promotion. So, you know, or you could change careers, right? You might be able to switch jobs into a higher paying job, right? That's better than working two jobs, unless you would absolutely hate that higher paying job, right? Um, so those are all different things we could do. Another thing we could do, and this might be the first thing you thought of, I think it's probably the first thing most people think of when they're thinking of budgets, and that's cut expenses. And look, that's fine. That is maybe the first place we should look. Cut expenses, right? So, you know, that's another thing we can do. Those are all things we can do to deal with deficits, right? Okay, moving on. Um, just a reiteration, if we have a deficit, what can we do? We can use savings. We can sell things like investments. We can borrow. Let's see if we got them all in the last slide. We can cut expenses. We can increase income. Nope, we got all those. Okay, moving on. After we created the budget, right, one of the things you want to do is you want to monitor your budget, right? And you do that with a budget control schedule. All it is really saying, hey, I made this budget. Did I stay on track? Like, it's like comparing your actual spend. Like if I did a monthly budget and I allocated, you know, let's say I allocated $10 towards food a month. Okay. Now you might go, well, there's no, like, who only spends $10 a month on food? Well, you're smart, right? Maybe I really think I could do this, right? And so I might have an unrealistic idea about this, but we'll talk about that in a minute, right? So I say I'm only going to spend $10 a month on food, and it's the end of the month, and I look and I spent $500 on food, right? And I go, and so the difference between those two is $490, right? Now, if it's just a very small amount, like it was $12, right? $2, no big deal, right? Okay, but it's very different, right? And so we want to go back and look at that and say, what's going on? Like, did I just lose control of my spending? That's one thing, right? Like, you know, let's say I allocated, you know, $400 for food, but I spent $500. Okay, well, it might have been realistic to go with $400 a month on food, but maybe I just didn't think about my purchases very much, and I ate out way more than I should have if I only wanted to spend $400 on food, because for a lot of people, eating at home is less expensive than eating out. And so I go, okay, next month I'm going to limit eating out to once a week. I'm not going to eat out more than once a week. And that should take care of it, right? So I can make adjustments to correct things. That's why I do a budget control schedule, to help me get on track. But the other thing it can do, like in the case of me saying, hey, I'm only going to spend $10 on food, it can show us that our goals for our budget were unrealistic, and we need to go back and revise our budget. If we only, you know, $10 for most people a month is going to be completely unrealistic for a food budget. And so, you know, this is kind of showing us when we're over by so much, right, that we need to go back to the drawing board and make a new budget. Okay. So we can continually update our budget, you know, as we go forward, as we get new information, like about our income and our expenses and things like that also. Okay, moving on. What statements are we talking about? So I'll ask you this question. You tell me which statement we're talking about. We're almost done. So if you've hung in here this long, congratulations. We're getting close to the end. Which statement looks at the past income and expenditures of a household? If you answered income and expense statement, you are correct. That's the one that looks at the past income and expenses of a household. Now, which statement gives a current snapshot of the household's financial statement? I'll give you a minute to think about that. The answer is balance sheet, right? That gives a snapshot of a household's financial situation. Finally, which statement looks at the future income and expenses of a household? Okay, time's up. It is a budget. Okay, let's see if we have another slide. I know we're close to the end. If not, well, thanks for checking out lecture 2. We do have another slide. Promise it is very close to the end. So let's look at this. How would we list this on our financial statements, right? The Smith family owns 100 shares of Vanguard's S&P 500 index fund. You don't have to know what that is. It's just an investment. So they have 100 shares of it. And each share, right? Each share they own, they have 100, costs $185 per share. So that means in total, right? It's worth $18,500. So they have an investment worth $18,500. Where does this go? On what financial statements does it go? Okay, think about that for a minute. We have financial statement, balance sheet, income. We have balance sheet, income statement, budget. Which one does it go on? Okay, with only this piece of information, right? The only thing I can say is that it should go on the balance sheet. Okay, I'll give you a minute. Think about where on the balance sheet it goes. Time's up. It goes under assets on the balance sheet, right? It would be listed under assets on the balance sheet. Now, think about the subcategories we had for assets. Which subcategory does it go under? Time's up. It goes under investments, right? It goes under investments. Okay, so it would be listed on the balance sheet as an asset under investments, and it would be listed at $18,500. Okay. The Smith family bought a $5,000 watch yesterday on credit. How much and on which statement? So this is the information we have, right? Which statement would this go on? Or statements, okay? So they bought the watch yesterday. How did they buy it? They bought it on credit, okay? Now, if we were doing a balance sheet today, would this go on the balance sheet? Yeah. Where would it go? Now, a lot of people get this wrong. A lot of people jump to the credit. It would increase their credit, their liabilities by $5,000. A lot of people see that pretty easily. Some people don't, but most people see that. It increases their liabilities by $5,000. Here's what a lot of people miss, and it's similar to the thing with the car. What happens to their assets? And some of you might have said nothing. You'd be wrong. Okay, because what did they get? They borrowed $5,000 for what? What did they get with that $5,000 they borrowed? They got a watch. Isn't that watch worth something? That watch is an asset. It's worth roughly $5,000. And look, assuming you could take it back, right? It's fine, listed at $5,000. Look, obviously, if you wore it all day and you tried to sell it to somebody else, I doubt you'd be able to sell it to someone else for $5,000. Look, if we're talking about the Smith family, maybe some of you suspect we're talking about, I guess that should have been capitalized, and it was Will Smith. Yeah, maybe somebody would buy that watch for more than $5,000 just because Will Smith wore it. But for most of us, right, if we wore that watch on our dirty wrist all day, you know, no one would want to pay the same amount of money we paid for it. So we'd have to sell it for something less. But let's say we could take it back to the store. So we can still list it on the balance sheet as an asset for $5,000. Okay, let's keep going. What subcategory of asset would it get listed under? Personal assets. So personal assets goes up by $5,000. And then current liabilities would go up. Let's say we're going to pay it off within the year, or let's say we bought it with a credit card. It would all go under short-term liabilities if that was the case. We bought it with a credit card. So short-term liabilities goes up by $5,000. What happens to our net worth? Assets went up by 5. Liabilities went up by 5, right? 5 minus 5 is 0. Net worth does not change, okay? So the balance sheet changed, but net worth did not change. I think we just have one more. Don't hold me to that, but let's go on.
Okay, let's look at this next one. Will Smith did a commercial yesterday and they promised to pay him $40,000 in 2 weeks. So which financial statement does this go on? So take a minute to think about that and go ahead and get in your mind what you think, which financial statement you think that this is going to go on. Now, let's see if you get it right. The financial statement that it's going to go on is the budget. So some of you might have put the income statement, and that wouldn't be correct in this case. It's more important than getting it right is knowing why you get it right. And so let's talk about why it goes on the budget and why it doesn't go on the income statement. Well, the thing is, he did the work yesterday, right? When if we're sitting down today to do our statements, anything in the past generally is going to go on the income statement. But remember, for households, we do things on a cash basis. So if we haven't received the cash for it yet, we don't record it on our income statement, okay? Now, we can talk quickly why it doesn't go on the net worth statement. So why doesn't it go there? And it doesn't go there because, again, they haven't received it yet. It's not a liability for them, anyways. It's not an asset for them because they haven't received it yet. So it's not going to go there. So it's not going on the income statement or the net worth statement, but it is expected that they're going to get this money in the future, right? And so we're going to record that on the budget. That's going to be recorded there. The budget looks at the future. So that is that example. Okay, last example. So we have the Smith family earned $850,000 last year before taxes. So think about which financial statement that goes on. All right, hopefully you said that it went on the income statement, or you could have said the cash flow statement because those double for the same thing for households at least. So why did it go on the income statement? Because it's income and it was received in the past, right? So that's where we're going to put it on the income statement. All right. So these can be tricky for some people. It's easy to make mistakes, right? But for others, they might find them kind of easy. The main thing is just to think about it and think about why it goes on that specific statement. That'll help you make fewer mistakes in terms of where to place transactions like that. Let's talk about what we covered in this chapter. So we covered financial statements, specifically 3 main types. We talked about the net worth statement, the income statement, and the budget. We talked about financial ratios, like the housing ratios that we discussed. The emergency fund ratio. We talked about some new acronyms like PD, principal, interest, taxes, and insurance, that you might not have been familiar with, and then just a bunch of terms, personal finance terms that you may or may not have been familiar with. So you got a little preview of them, even though, for example, we talked about mutual funds. This chapter isn't specifically about mutual funds. That'll be a later chapter, but we kind of had to talk about them because, for example, on the net worth statement, if you owned a mutual fund, that's an asset and you need to put it down. So we just gave a quick explanation of what it was. You can always turn to something like Investopedia to get more information on the terms that you're not familiar with. Some other ones we talked about, IRAs, 401ks, and we're going to be talking about these things throughout the chapter. The main thing about this course is it's to help you be a better consumer and to basically manage your money and your personal finances better, right? That's one of the main things you can get out of this class. Some people might turn this into a career, and so this could be a starting point for doing that. But also, we'll talk about these issues and these personal finance topics as they relate to things you might vote on as well, because that's also relevant. Politicians make tax laws, they make laws regarding regulation of financial services industries, and so that can affect some of the products that you buy or the investments that you can get into. And so when relevant, we'll talk about that.